My next guest is a real estate investor who got started in the 2000s. He talks about his journey of investing through the recession of 08 and 09 and how much properties have appreciated from 2010 through really 2022, 2023. We do spend a lot of time talking about where real estate may be going from here, which is a really interesting conversation I haven't had on this podcast before. So with that being said, please welcome Joel Farrell. Joel, welcome to the show.
No, thanks, Sean. I'm pumped to be here.
All right, good to have you here. So why don't you kick us off and tell us about your background?
So I got into the mortgage industry in 2006 out of college. So I've been doing that for a long time. I got into real estate officially in 2009, started building a portfolio here in Missouri, also started scaling into Florida. And then myself, along the way, started a podcast last year called Strive for 25. It's all about helping somebody increase income, save, and have options to invest. The 25 is, hey, somebody can save 25% of their income. They're going to be in great shape, which is obviously a massive goal. But anyway, wrote a book. So just finance related is really kind of my focus.
Awesome. So you've got a few irons in the fire, you could say.
Probably too many, but that's okay for now.
Hopefully not too distracted. But this podcast is all about building wealth, financial freedom. So I really like the name of your podcast there, Strive for 25. We do, with our platform Ticker, we actually encourage people to try to invest between 15 and 30% of their income every month. And if you can do that, you're going to be in good shape. However, if you can't get to 15, we say just kind of work your way up to that. Start small, work your way up. But I like the philosophy there, very much aligned. But let's get into the passive income stream, real estate. So you got started in 2009, right at the crash. Way to go.
Yeah. So I bought my first house as a condo in September of 2009. So the first time home buyer credit had just come into place and it was not repayable. So that was end of 2009. And me being in the mortgage industry, rates were dropping. So, in that time frame, when I got in 2006, rates were like 7%, 7.25%, and they started to kind of come down to the sixes. And then the crash happened. And, being in the mortgage industry then and also now, I will tell anybody, and maybe this is just me personally, but this has been a harder go than that was. We were doing more loans in that time frame. And that's a whole different story. But by the beginning of 2009, rates dropped from 6.25% to 5.25% within 4 or 5 months. And so we were busy doing a lot of loans in that time frame. So I felt I had the confidence to be able to purchase a home at the end of 2009. And that's kind of how things started for me personally with real estate.
Got it. And with a lot of the guests that are on this podcast that talk about real estate investing, what they do is they keep their day job, which mortgage industry, that's the one stream of income in your case. And you still have that today. And then you use the investments from real estate to keep investing in other properties. Is that what you did essentially? 2009 was the first property. When did you get the second?
Yeah. So people have different philosophies on real estate. I'm a buy and hold type of person. And having a full-time job, I only have so much capacity to be doing other things, whether it be, finding off-market properties or whatever, or flipping properties. So I'm a big proponent of what I call the stair-step method. I didn't know what I was doing at the time, but this is kind of what I call it in my book, how literally anyone can become a millionaire. It's a 70-page parable type of book. But buy a property, live in it for a couple of years, save up, buy the next one as a primary residence, and turn the old one into a rental. And I did that a couple of times, and property values go up, pay the mortgage balance down. If you can just break even on cash flow over the long term, you're going to have a net positive with the equity buildup. So that's been my philosophy early on. And as things kind of evolved in my journey, I was able to get into a few more other things along the way.
Gotcha. So do you still do single family, or did you kind of level up from there to multifamily?
Yeah. In 2017, I got my first multifamilies in St. Louis, and then also a commercial building that we rehabbed. And actually, we run our mortgage operation out of this commercial building, and then got a short-term rental in Destin, Florida, a couple other multifamilies along the way in St. Louis. And then now I'm doing a land development project, going to build some homes in Florida, Santa Rosa Beach, Florida as well. So kind of a gamut of different things.
Yes. I haven't had too many people on the show talking about land development. So I want to touch on that in a second. Let's touch on the multifamily. Are these 4-unit, 8-unit, or bigger?
4 units.
4 units. Got it.
Yeah. So I didn't house hack. Now, obviously, I would have loved to be able to do that younger if I knew more about it. Buy one FHA 3.5% down, live in one unit, rent out the other ones. I didn't do that. I bought them outright as investments, and I did them with commercial loans. And that's another thing that I did some pretty creative stuff back in that time to be able to kind of create a scenario with cash flow, but also minimizing the out of pocket at closing. That's a whole different kind of thing. But that was in 2017, so it feels like a lifetime ago, to be honest.
Yeah, 6-7 years now. Why don't you drill into that a little bit? What are the risks you were facing at the time?
So I think there's two sides of that question. You have risks of when you get in and what you're facing with, because you're dealing with a lot of unknowns. You don't even know, like, you can do as much research and talk to as many people and do all the data crunching. But there's stuff that you just don't know. And the things that I didn't know and weren't prepared for were just like, these are old buildings. They were built in the 1920s. They're brick. And they're just more stuff that I had to fix and update and re-repair over the course of a number of years. And along the way, I've started to kind of fully gut rehab some of the units one by one. But that, like, you go into it thinking, hey, I think the expenses are going to be this dollar amount or this percentage. But for me personally, just kind of the unknowns, just don't know what you don't know, kind of a thing.
Right.
But the biggest thing for me personally is that, like, I was able to just some years cash flow a little bit, break even, but the values, they basically doubled in a short period of time.
Can you give us some raw numbers here?
Yeah, so I bought one property for $150, and it was not in the best shape, so I had to do some rehab to it. And then this, I guess a couple years ago, it appraised in the 330 range.
Nice.
And like, kind of going back to the scenario where when I'm talking to somebody on a residential loan, there's limits on what you can have a seller cover in closing costs. Like, if you're buying a primary residence and you're going to do a primary residence loan, conventional, 5% down, 3% down, 3% is the limit of seller credits that a seller can give towards closing costs. And an investor, if you're doing a conventional loan for an investor loan, it's 2%. In this scenario, because it's a commercial loan, you don't have all those kind of federal regulations that restrict you. So I had a $135K agreed upon purchase price with a seller, off market essentially. And what I did is I got to that point, and then I knew the value of the property would come in higher. So I took the contract price to $150. So up 15, out 15. When I say out 15, I mean a $15,000 credit towards closing costs.
Got it.
So that helped me minimize my out of pocket. And then the appraisal came in like 172. And then I was able to restructure a couple of things to even lower my out of pocket with that as well, with prices and loan amounts and things like that, which you can do on commercial loans you can't do with typical conventional loans.
Gotcha. Okay. Very interesting. All right. And then today, how many properties do you have?
Like 15 units, I think.
Okay. Gotcha. And they're all spread out. It sounds like not just in your area, but outside the state.
The majority are in St. Louis, and I've got a couple units in Florida.
Gotcha. Okay. So why don't you tell us about what's your strategy? Do you aim for like a certain target price or maybe a part of the city? I've talked to people, they like, in some cases, investing in like working class areas that I mentioned this in the podcast before, like areas close to hospitals, because you have nurses, sometimes doctors in med school. They're rarely in their apartments. So that's a great renter, like when they're paying their rent, but they're not always there. So I want to hear your strategy here.
Yeah, I mean, from a multifamily standpoint, here in St. Louis, there's a certain kind of geographical area where you're going to have multifamilies. And then within that geographical area, if you are hyper focused on a certain area, you're going to get a better feel for which neighborhoods are more risky, which are less risky, which are kind of up and coming, which are not. And here in St. Louis, my properties are in Northampton. So like, if you look at the South City area, it's kind of northwest of the city. The further south you get, the less the rents are. Certain pockets are, maybe more risky. So I think being hyper local and looking at it from a longer period of time is a really important thing to be thinking about, because you're going to be able to get those little bit of nuances and details that you wouldn't get if you're spread too far. But at the same time, I had somebody on my podcast. I'm not going to name any names, Chris Stout, and he's in New York, and he's talking about hyper local, and he advises people to not invest over state borders. Don't invest outside of your local market. And I agree with a lot of the principles, But if you live in California or Hawaii or New York, I mean, the affordability levels are just out of the off the scale. So if you want to buy real estate and get into the game, you're going to have to go across state borders. Maybe it's in the Midwest or Ohio or Florida or the Southeast or whatever. So I don't like the whole, rule of thumb thing. I think there's always exceptions to the rule. And that's kind of, I got stuff in Florida, and I wouldn't have gotten down there if I didn't expand my horizons.
How do you do a deal like that that's out of state? Do you have like a network of other people that are like, hey, I've got this property you might be interested in. You want to take a look?
I bought that property sight unseen. And I say that with a caveat because I knew the neighborhood. I knew we had a friend of the family that has a home there. And this is short-term rental market on the beach, Emerald Coast, Northwest Florida. So I stayed in that person's home for a couple different holidays. And so I knew the area. I knew the scope of kind of what was going on. So, I had a realtor that I knew personally that helped me do some FaceTimes and whatnot. So I say sight unseen. I didn't physically see it, but I had a grasp for the area, the numbers, the markets. And so in that time, are you familiar with 30A? Like Alice Beach, Seaside, Rosemary?
No. Mm.
Okay. The movie Truman Show.
Oh, yeah.
With Jim Carrey.
Yeah.
That was filmed in Seaside. And like 30A is a series of 12 different little bitty towns that all have a unique little vibe and feel. Like Rosemary has this kind of like French feel. You're talking like $15 million, $12 million, $20 million, like on the water. Alice Beach is this like white stucco area.
Yeah.
3,000 square foot villas that are like, $7 million. So like that area was super high priced in terms of the rents you're going to get. And so you're buying the lifestyle, you're buying kind of the long-term value and appreciation. And like Destin is where my property is, which is kind of the hub where it's been there for a long time. The values in 2021 hadn't really matched the rental potentials. And so that's kind of the reason why I decided to buy there at the time. And there's more that goes behind that story, how I got there. But, I'll say that for a different day.
Sounds good. Yeah. Cause some people they want to know, how do you do those deals that are outside your city? Right away, of course, I assume with all your properties, you're using a property management company. Is that correct?
Yeah.
Yeah. When you first started, did you kind of do the fixing on your own? Did you just go right into a property management company and have them do the heavy lifting?
So the Florida one, I mean, it was already fully furnished, already operating. They already had, all the bookings
Nice.
Ready for the summer. So it was just kind of buy and then kind of just coast in and things keep rolling. And the 4 families, that's obviously a little bit of a different game. Long-term rentals, that was more work that had to get done and getting contractors in there and getting some things set up. But like the best advice I would give to somebody is that you don't have to rush. You can take your time and really kind of talk to people, meet people. And it's okay to put offers on properties, especially if they're aggressive, because then you can get a feel for how a seller may respond or how a seller may counter, or they may not respond at all if you're too aggressive. But like, if you feel like done the work, done the math, run the numbers, and hey, if I got the property at this price, I know that there'd be a little risk. Now that may be some work on an agent to do that work for you and put the offer in, and they may shy away from it if it's too aggressive. But what if somebody says yes? If somebody says yes on your aggressive offer, then you got to be prepared to press go, have the financing ready to go, and then be able to operate and execute.
We're kind of coming out of I'm looking at this from a stock investing standpoint, which is our main model. 2022 was really a bear market recession, I would even argue. And 2023, the first part of it, we really felt it. People were sitting on the sidelines when I tell people, hey, you should be taking action now because this is where you make your big returns. What are you doing right now? Are you kind of waiting for opportunities, or are you hitting the market, like finding some deals?
I love this conversation because there's the question of, if I'd have known this 10 years ago, this is where I would be today. I hate that question because I know me personally, even if I had all the gold nuggets of what I know today, and I was there telling myself in my ear, hey, do this, like, would I have listened? It's like, would I have been in the right frame of mind to be able to take that information and actually execute it? And the question is, I don't know. So, but besides that, like the way that I look at things right now is real estate, for me personally, this is how I look at it. Real estate is the tip of the iceberg. And what I mean by that is that you may see somebody with a multi-million-dollar portfolio, $20 million portfolio, whatever the numbers are, and you say, okay, that guy's successful, that woman is successful, XYZ. Um, but the most successful investors, in my opinion, are the ones that are focused on other things to drive income, to build context, to have confidence to be able to get in the market. So like for me personally, I look back at that 2009 timeframe, like I was working all these hours, doing mortgages, trying to be able to make money and save money. And as my career kind of evolved and whatnot, that was my focus. I was focused on my clientele, focused on the business and trying to be able to increase income. And so that gave me the ability to have the money saved and also the confidence to be able to take a risk. Because I remember 2013 was a unique year where prices were going up and things were going in the right direction. And there was all this talk of, what if prices go down? What if there's another
I
crash?
remember. Yep.
And so like I was hesitant on doing anything. And like when I first put my first dollars in the stock market was in 2007, and then it gets cut in half within a couple of years, I was scared to put money in the market. I didn't want to do that. Like, I'll just do it. I'll do it on my own. I'll day trade here and there. And that's a whole different story. But I ended up buying a property in 2013. I look back on, thank God I did that.
Yep.
I call it the eye of the storm. Like you're in this period of time where you're working on stuff. You may not see results. It's calm and nothing's going on around you. But in all reality, all the things that you're doing are either helping you or hindering you. All that storm is boiling around you, and you may not see it. All those little things you're doing, actions that could be happening for you or against you, they're compounding at little bitty increments. And it may be 5 years, 7 years until you see the results. Like, and that's kind of how I look back, from 13 to 17. And 17 is when I got the 4 families. And then a couple years later, it wasn't until 2019. So like really 10 years into my journey, like, oh, sugar, like I've got something here. I should have been buying more stuff along the way. What was I thinking? But I wasn't seeing the results. I wasn't seeing how the whole picture fit together. I didn't have the blueprint. I didn't have a mentor. And that's why I mean, like the eye of the storm, like I didn't know what was going on. And that's it. Hindsight is always 20/20, right? But like the results, they come in time.
That's investing for you. Like it's such a delayed gratification strategy, and it's like this slow process. And all of a sudden, years later, it's like, bam, big numbers start to show up in your, if you're investing in the stock market, in your broker or the real estate, the cash flow really increases, or the value. Like you gave a great example of a property that doubled in a short time frame. It's like, nope, you're not going to see that overnight. You have to wait.
Mm-hmm.
Go ahead.
I was just gonna say, like, another thing that I've been talking about on my platforms is Gen Z. Like Gen Z, is this gonna be a generation of people and beyond who don't own homes? Like, because the affordability is gone off the roof. The prices, the money you need to be able to, have for down payment closing, it's just widening and tightening. And so like that's something that gets me fired up is, are we in the middle of a brewing of a generation of renters? And that's scary to me.
Yeah. What are your thoughts on that? Because I think about that all the time. My wife and I were talking about how are these kids that are now 22, 23, 24 coming out of college, if they get into a decent job, still the homes are ridiculously expensive. How are they going to buy a home? Are they just going to stay in a renting situation?
So there's 2 parts of this conversation that I think are important. And the first part is, the price conversation. Hey, prices have gone up so much in the last 3 or 4 years with, coming out of COVID, and the prices have to come down, especially with rates coming up. Like you would logically think prices would have to come down. There's a supply and demand imbalance. But what some people may not be aware of is that there's also a lack of inventory, and that lack of inventory is holding prices up from the residential standpoint, not so much commercial real estate standpoint. And so you dig deeper on that scenario, and people in 2020 and 2021 were refinancing their mortgages in the 3s and the 2s. Like 3.25 had always been the floor of rates that I had ever seen. It wasn't until COVID that rates went below that floor and we saw rates in the 2s. Those people are probably never going to sell that house. Even if they move and buy a house that maybe has a high rate, they're going to keep that as a rental because a rate that's 2.5%, that's an asset in this environment. So you have this lack of motivation to sell. So you're going to keep it, stay there, or you're going to rent it out. So that's pushing pressure on, the minimal amount of inventory out there. So prices are stabilizing. So I believe that, you're going to have that lack of inventory is going to be the new normal. Like in the mortgage industry, 2021, there was a stat. I think there was like 180,000 people that had a lending loan officer license, the bank or mortgage company, whatever. That number is like cut in half as of 2023. So people are getting out of the industry. Same thing with realtors. I don't know the number, but going into 2024, it's going to be even lower because this has been the hardest year. Like my numbers are down by 50%.
Wow.
Overall. So I say that because we're kind of in this new normal in the real estate industry. And so I don't think prices are going to go down. Maybe they go down a little bit. I don't think you're going to see a crash. There's nothing really that shows data that there's going to be a massive amount of people defaulting and then having the supply increase. So if that is kind of where the data really is heading towards, and then you have the idea that, hey, rates went up so fast. So in 2021, we were locking rates in the low threes in December of 2021. By May of 2022, rates were in the mid fives. By June, we were in the mid sixes. So they went up so fast, and the markets weren't really, able to handle that, I don't think. And so as fast as they've gone up, now this UBS article that came out a couple weeks ago talking about predicting that the Fed's going to lower the Fed funds rate 200 to 275 basis points in next year, which I think a lot of the information makes sense with economic data slowing, and we were in an election year. So I think there's probably going to be a push to make the numbers look rosy. So if rates go down considerably next year, everybody that's been on the sidelines is going to jump back in. So I think prices are going to continue to go up. So which, coming back to the Gen Z conversation, if prices in 5 years are, say they go up 5% every year, 4% every year, I mean, your median house price is, I think, is in the mid fours now. It'll be in the fives or six, whatever the math is. And then coming back to the income side of things. So if prices are going to continue to go up, you have more people in the country, you have limited amount of housing supply. I think the construction industry is like 5 or 6 million new construction starts behind from historical standards. So there's a need there, and that's not catching up anytime soon. So what's the end result? What's the solution? You've got Gen Z making average wages, not able to save money with inflation. The only way to solve that problem is to get creative as hell and understand why it's important, and then go do it. And I'm gonna stop there because I have some other thoughts on that. But I've been ranting.
No, I think this is gold. This is really good perspective. I've been thinking about, I look at stocks that are related to companies that are building multifamily complexes, not single family. And almost leaning into that is maybe that, I don't have data on this, it's just an assumption, but maybe it's going to be mass production of these state-of-the-art tech-infused properties en masse. It's got everything installed. I think of like, I kind of not renovated, but I added Google. Like my whole home is powered by Google now, thermostat and whatnot. And it felt good to get rid of the old Honeywell systems from 20 years ago. But I look at all the tech that can go in, and it's like move in ready. You don't have to mow lawns. It's like, I see maybe that going, or maybe that's going to be the future, and people don't have to, put down, let's say $100,000 on a home that's like $400,000-$500,000.
So in that scenario, you're talking about like townhouses or condos, or like
townhouses and condos, correct?
Okay. Yep. Okay. Yeah. I mean, I think that could definitely be a solution for sure, because they're building. I think the apartment complex starts is like at record highs. So if you convert that energy and resources to building things like condos and townhouses, I think it could be a great solution for affordable housing. But someone's gonna have to do it. Someone has to see the vision and see the reward, because at the same time, it's like, if I'm putting my neck out there to go build something, I need to be able to maximize the return and also minimize risk. And building condos, I've never done it. So I don't have a lot to say on it, but I just know from a standpoint of risk and reward, there's some risks that go on. I've seen condo complexes, not sell out properly, and then,
Sure.
it gets stuck. So it's damned if you do, damned if you don't kind of a thing. But like, okay. This is the one thing when I meant creative, for the person that's coming into the workforce and early on in their journey, I hear and see a lot of people that are, living with their parents. I lived with my parents since I was like 25 when I got out of college, and I was saving money, a little bit of money. I could have been saving more. But housing, if somebody believes that that's positive for somebody to go down that path and own a home, Okay, then putting out the vision of, okay, I'm going to stay at my parents' house, save X, Y, Z, 10%, 15%, work up to be able to save the money, or get creative. Okay, maybe I get a gift of funds to be able to buy the house.
Yeah.
If you think and agree that prices are going to be higher in a year from now, then maybe it's an incentive to get creative to buy that house today, and get in at an entry level standpoint. Because once you get in the game, this is something I talk about all the time. Like, let's say you buy an entry level house that's $200,000. It's not your forever home. And it does kind of fall back into the kind of the stair step method. Okay, buy a house, live in it for a couple of years, save
Yeah.
up, buy the next one. But once you're in the game and you got the responsibility, everything in life changes. Now you've got the pressure and the incentive to be able to save more, to be responsible, to do the X, Y, Z, to be able to keep things. So like getting creative with your resources, your family, your friends, to save the money up to be able to buy, because then it's a stepping stone to the next thing.
Right on. Right on. Do you see homes appreciating as much as they have, let's say, over the last 5 years? Like you mentioned, probably like my home value just significantly increased faster than it ever has over the last, I'd say, 3, 4 years. So you go 5 years out. Do you think we're gonna see that same appreciation, or maybe it'll flatten out a little bit?
I think the answer to that question, in my opinion, is completely unknown. There was a
Mhm.
video by Patrick Bet-David that was talking about kind of, okay, if the Fed lowers rates significantly, kind of, he was comparing kind of a hyperinflation standpoint of like a Zimbabwe, and I forget the other couple countries, where asset prices just completely rose. When you print $3 or $4 trillion of money into the economy like they did coming out of COVID, I think there's a lot of unknown. Like, it's never been done before in this country. So I think there's a lot of unknown of what the effects could be from a 5, 10 year standpoint. And, that kind of that gap between the best and the rest, like, people that bought a house 10 years ago, now they've got two or $300,000 of equity. Now they can be creative to be able to buy the next one. So the people that are able to make moves in this market right now with prices going up are the people that have built up the resources. So if you're 35 years old and all you have is a 401k and you don't own anything else, it's going to be challenging to be able to be nimble in this market to go get something. So, there's a lot of money on the sidelines. So like, I don't know. It could be the next 2 years, right? The highs could go up 10% and then it flattens out. It could be the exact opposite. I don't know. I think there's, because of all the money that's out there, that's on the sidelines. And I wish I was smart enough to be able to figure out how to evaluate that type of data of how much money's on the sidelines, and cash or whatnot. Like,
Right.
I think it'd be interesting to dig deeper on that.
Right on. Yeah, we'll see what happens over the coming years. This podcast episode is sponsored by Ticker. Ticker is a platform that helps you manage your own investments with confidence. Check this out. Let's search for Apple. You can see Apple is on sale. That's looking good. Score is 61 out of 100, and margin of safety is 75%. Higher the score, the safer the investment, and the higher the margin of safety, the higher potential returns you can make. In this case, you can see the share price is 175 as of the recording of this video, and the upside potential, the fair value, is 398. All right, let's look at a different stock. We'll go to GameStop. In this case, GameStop is overpriced, scores 39 out of 100. That's not looking too good. And the margin of safety is 0%. Here's some other features within. You can create your own custom dashboard. I like to set up and take a look at the top gainers and losers in the last 24 hours. I also like to take a look at the top search stocks, but you can really customize the dashboard to whatever you want. We have stocks, ETFs, crypto. This is a big one. We have a watch list tool that allows you to add stocks to the watch list. And if anything changes, such as that score or margin of safety, you automatically get notified. I call it the set it and forget it feature. And then we have portfolio trackers and alerts. So if you're looking for strong stocks, want to avoid bad stocks, and learn how to invest, I invite you to join Ticker for free. No, really good perspective here on from your standpoint on real estate. Usually I'm talking about people's strategy, what their value is at, like overall value, all that kind of good stuff. But this is like zooming out, a more macro approach to the market in general. So thanks for that insight. What I'd like to do next is transition to your book. Got it queued up on Amazon here. How literally anyone can become a millionaire. Why don't you dive into this a little bit?
Yeah, I mean, like, not to use the word literal again. Don't take that message literally. But like, if somebody wanted to become a millionaire and they wanted to put the work in, it's possible. Like, people are doing it every single day. Now, it's not easy. Not everybody wants to do it, or not everybody, wants to put the work in to do it. But in the book, I have an example. It's more of a parable, but it's loosely kind of tied to a couple different clients that did this. But the book kind of talks about, wealth building and compounding and automating, which is all stuff's out there. But, if somebody can save $100 a month, in this environment, like that might not seem like a lot of money, but that's a massive success in my eyes because, if you're 23 years old and you're making $20 an hour and you've got the rent and the car and insurance and this and that, like, and when you're that age and look back on it, it's like, okay, when so-and-so comes back in town, I'm going to the bars and I'm going to go hang out with them because it's their birthday or it's a baby shower, whatever. Like, things come up, right? Like saving $100 a month is not, linear. It's, hey, this month sucked. I had to spend money on the car and then I got to make it up next month. It's a roller coaster, right? But if at the end of the year, you can save $100 a month, all things going on with the cost of living going up so high, that's a massive success. It's a little bitty, step that you can build off of. So that kind of mindset, atomic habits, compounding. So one of the stories I talk about is the stair-step method. And this is somebody who, when I met this person, they're making about $40,000 a year, had a 580 credit score and no savings. And but they had a vision of buying a house and they wanted to build a portfolio. They had read Rich Dad, Poor Dad. And so we looked at all this stuff. Dude, you got nothing to cut. Like the input and the output, there's nothing to cut. So what are we going to do here? So we talk about the formula. The formula is so simple. Income minus your expenses equals your savings. That's it. It's as simple as that. So, okay, you got your day job. Okay, what else can we do to, how can we increase income? It's like, well, I know somebody that's got a installation company that maybe I can pick up some hours on the weekend. So $40,000, that's 3,333 gross income per month. And he was saving 0%. So he went and got this job, worked weekends, and within 2 months, he was making an extra $2,000 a month. Okay. So when you do the math on that, after taxes, he was saving 20% a month just by flipping that equation and focusing not on the expenses, but focusing on the income. And so he saved money, paid off a couple of credit cards, got his scores up, bought his house, and then kind of that stair-step method, bought a property for 150, saved up. A couple of years later, bought the next one at 250. Now I'm using round numbers. That's kind of tied to the book. His story is different. So 150, 250, 350, 450. So that was year 7.5 that he bought that fourth house. And then when you do the math on that over 30 years total from the very beginning, now I got to ask you the question. Using say 4% house appreciation, what would you guess that portfolio would turn out to be over 30 years?
Multi-millions.
Yeah, the number is like 3.1 depending on all the variables. So like literally buying 4 houses could turn you into a millionaire. And it's just like, okay, most of the people that are my age, I just turned 40. I got a group of people who we just went to Mexico for our 40th birthday. And of all of this group of 7, I'm the only one who's got rental properties. Everyone else has got family, job, 401k, they're good. And it's like, 401k, that's all you got. You're not really diversified.
Yeah.
And I've helped some of these people buy houses, sell the house, get the cash, income ratios are in good shape, buy the next house. And you have more equity in the next house. Cool. My path was different. I kept those properties, and that like little bit of detail became the difference between having a portfolio or not. It's like, what do you do on the second one? Do you keep it as a rental or do you sell it? And there's no right or wrong answer. It's just the path that I chose. And if somebody has that vision of going down the path, it's just something that to be aware of. And when I talk about being creative in Gen Z, like there's people everywhere that are building agencies online. I'm helping somebody with their Facebook ads. I'm helping somebody with, editing videos. I'm helping somebody with copywriting, helping somebody with XYZ. There's ways to be able to generate income. And I think that the people that I'm seeing get ahead that are younger are people that are focusing on these other income streams, which is what your show's about. Yep. And that's why I believe that if somebody wants to do it, there's a path to do it. But it's not going to happen overnight. It's a time thing.
Yeah, right. Love it. This is gold. Thanks for that insight. And you're right with finding side hustles today. It's so much easier. You can go to platforms like Upwork and start to put yourself out there. You can also, figure out where do business people need the most help and then go to them, try to solve that problem, whether it's like marketing. You mentioned marketing is big, like Facebook ads, YouTube ads, Google ads. I think a podcast editing, it's the most non-glamorous thing ever. Nobody wants to do it. Be the person that does the selling, go to Upwork, then have somebody do the editing. That's what I do. Like, I found great talent. I got a great team that has been able to help me build my business. And Ricardo, he's our editor. He's fantastic. He's been with Ticker for a few years, and it's like, you can find awesome people to really accelerate, and they can be anywhere in the world. It's beautiful.
I love it. I love it. And like, one of the things I talk about is being stuck in the comfort zone. And, when things are going good and, you got everything you need, maybe you've got something that's inside you, like, yeah, I want more. Yeah, maybe I want to retire early. But it's like, me personally, I look back and it's like, I started these platforms literally like 9:00 at night. And I had this vision of what I wanted to strive for 25 to be, going back 7 or 8 years. And I'd done a couple of speeches and talks and got in front of groups talking about these concepts, but I hadn't really done anything with it. So it had been inside me, but I did nothing. And then 2022 happened, and I saw the writing on the wall, and then, okay, what I've been doing in the past is not going to be good enough going forward. So if I don't press on the gas pedal, I don't know how my life is going to look going forward with my job. And so, I went down this path, started the posting on Instagram with Strive for 25, and then in September started the podcast.
Mm-hmm.
And that comfort zone, like, okay, like, I need to get going on this. And, I've got kids, like, get up, get them to school, go to job. My wife works as well. So she's working till 6. So I got to pick the kids up at 5, get them dinner, playtime, bath. And they want daddy to sleep next to them until they go to sleep in the bedroom. So it's like 8:30 rolls around. And like, I'm laying on the ground for maybe an hour next to them, helping them go to sleep.
Yeah.
And like, the wheels are turning in my brain. Like, okay, I need to get, when they go to sleep, I need to get back to my computer, get back and work on stuff. And like, that pressure of like, okay, that means I have to ramp back up. Like, when you're laying on the ground for an hour, like, that energy
this is good.
Gone.
Yeah.
And like, there are days that I would do it, days that I wouldn't do it. And that pressure, that like beating myself up, like, I gotta get this stuff done. Like, that was killing me. And like, right place, right time. James Clear's Atomic Habits. Like, I'd heard about the book and I started reading it. And one of the things that stood out to me that hit me hard was he talks about the 2-minute rule. And, he kind of illustrates this person. He coached somebody to, hey, if you want to build a habit, this is what I want you to do. I want you to go to the gym and I want you to just be there for 2 minutes. Don't do anything. Don't do any exercise. Just be there for 2 minutes and then do it again tomorrow and then do it again tomorrow. And then I forget the exact kind of time frame, but sooner or later, it's like, okay, well, if I'm here, I need to go do some actual exercises. And so they did it. And he uses the word kind of mastering the art of showing up. And so I adopted that. So like, okay, I'm going to turn on the timer, go to my computer, and then do something. That something was like literally like one email. So then I turned off the timer, and it was the weirdest thing I ever done. And I walked away like, okay, this is weird. Okay. And I did it again, and then I did it again. And then I think that by day 5 of doing that, I'm like, okay, I'm here. I'm going to get to work. And by day 14, this is what blows me away. And one of the things I talk about is how the work and the process, it changes you. It's not about always about the information, but the process can change you, because by day 14, that stress and that anxiety was gone. Now I was looking forward to doing that work, looking forward to opening that computer and figuring things out. Like, I look back, I'm like, holy crap, like, that happened in, I think that was going on in June. And then July 12th is when I started posting on Instagram. September is when I started the podcast. And I've just been going, I don't have all the answers. I haven't had all the answers. And you don't have to have all the answers. But by doing it and doing it, it sets yourself up to be able to get better down the road. And like, I'm just so thankful that I haven't stopped.
Good for you. It's like a procrastination breakthrough moment, because there's that anxiety first, and then you're putting it off second. All right, I'll get to it. No, I'll worry about it tomorrow. But as soon as you get into that mode, that 2-minute rule, I've actually never read the book. I got to check that out, but I get the principle. Like, just try it. All right, 2 minutes, back off. Next day, do it. I had to do that with podcasting too, to kind of ramp up, like, stick to it, because you're learning this because you're fairly new here in the last year. But there's a lot of podcasters, they don't make it past like 2 or 3 years. Yeah. And they don't stick to it. And it's like, I made the commitment, like, okay, it was like 1 episode a week. Now it's 2. Now it's up to like 3. But it's like, all right, stick to it. This is the rhythm, and you're not backing off the gas pedal. Let's go.
Yeah. Like, question for you, what's the one thing that you learned that like never even entered your brain to even think about at the beginning?
About podcasting or just
Yeah,
habits?
yeah, about this journey. Yeah, the podcasting.
So what I learn, um, I had assumptions and they turned out to be correct. I can drill into that a little bit. So two reasons I started the podcast. One was networking. Like you can't get anywhere in this world alone. You have to be networking with people. And especially, when I first started, this was COVID. Like, you can't shake hands with people. So what do you do? So I knew like networking was huge. What I guess I learned is on that note, it wasn't just people around the States. I built friendships with people all around the world. It's so cool. And I'm so thankful for that reason alone to start the podcast. Number two reason, this was an assumption, it turned out to be correct, is we do promote Ticker on the podcast. We have like a commercial or two, and we do get people trying out the platform, and we're a free trial platform, low touch. So we do get leads, that's great. It worked out that way. So yeah, the two assumptions turned out to be correct. The big surprise, a lot of fun meeting people all around the globe. That's something special in itself.
Yeah, I totally agree. Like, and that like finding your own tribe, kind of a mantra, something that like it didn't really hit home. And there's somebody that I met on Twitter, going down this journey that I currently like I'm really good friends with, and now he's got me on his YouTube channel. He's building, he's got like a kind of a rotation of 3 people, and he has me come on. And it's like that person's in Hawaii, 4,000 miles away, and like we're friends. Like it's pretty cool.
That's awesome. Well, this has been awesome, Joel. What I'd like to do next is transition to the rapid fire round. This is the part of the episode where we get to find out who Joel really is. If you can, try to answer each question in 15 seconds or less. You ready?
Ready.
All right. What is your favorite podcast?
It's The Game by Alex Hormozi.
Okay, sure. Yeah. All right. What is a recent book you read and would recommend?
The book Winning by Tim Grover.
Never read it. I'll have to check it out.
Yeah, it's a bottom line book. Because again, Grover trained Jordan, Kobe. Like, if you want to win, like, he just gets it to the bottom line, and yeah, it hits home for me.
That sounds like it's right up my alley. Actually, I'm going to add that to I'm on Amazon right now with your book teed up. So we got 2 books going to the cart as we speak. There we go. All right, next up, what is your favorite movie?
Oh man, like, not to be cliche, this is what comes to my brain. And I wouldn't have said this probably 10 years ago, 20 years ago, but it's so cliche. It's Field of Dreams. Kevin Costner. If you build it, he'll come. Like, just James Earl Jones, and just it's nothing more than just like, the message of like, I played baseball growing up, so I love baseball. It's special to me with the relationships. So that book just stands out. The movie stands out.
I love that movie. Classic film. Have you ever been to the ballpark in Iowa?
No, that'd be cool someday.
I've got to go. Yeah, I've got some family in Dubuque area, and I think it's just an hour away from there. But anyway, it's like, you've got to go, Sean. If you're down in Dubuque, you gotta go. That's cool. All right, next question. What is the worst advice you ever received?
Oh shoot. Okay, this is so specific, so bear with me if this doesn't make sense. Dude, you're a mortgage person. What are you doing? That was said to me by somebody in my circle talking about the podcast. Dude, you're just a mortgage person. Who do you think you are? Okay, I got you.
Okay.
Not really advice, just a statement. So sorry.
Yeah, right. Well, flip that equation. What is the best advice you ever received?
Oh man. I mean, I'm going to say this out loud because it's coming from Hormozi's book, $100 Million Leads. It's, if you want to be ultra successful, it's about give some more until they ask. If you can do that, if you can figure out how to do that with your business, imagine how many people are going to see value in what you offer.
100% agree. I love that. Yeah. I actually just picked up that book like 2 weeks ago. It's sitting on my shelf. Haven't opened it. Getting there.
Yes. It's okay. There's time.
I'm working through Who, Not How as we speak.
Yeah. So that's one of the books that I have I have a morning routine where like I read a couple different things that kind of I cycle through. And so that's one of the books I'm starting to read in that routine. So yeah, I love that book so far. Right
on. All right. Last question. If you could go back in time to give your younger self advice, what age would you visit and what would you say?
Damn. I hate this question.
You said you didn't want me to prep you, and you're like, nope, let's get into it. I'm
Well,
like, all
I
right.
hate it because it's hard. It's hard because what's going through my brain is like, okay, would I've actually listened to that person? Would I have actually taken the advice and done it? What could have been the most impactful? And yeah, the best advice I could have given myself, it would have been in 2017. 2017, focus on the long term, not the short term. Very general, but like what was going on in my life, I was doing some short term things that was a distraction that's distracted me from kind of what I could have been working on at the time.
Although it's simple advice, I do love it because it's a reminder for all of us to really, really think long term, especially with investing. A lot of people they get back into that short term habit, and that's not going to do yourself any favors. Think long term, stick to the plan, stay disciplined. Things are going to pay off big.
I add on to that for like one thing.
Sure.
So part of kind of what I was talking about was the tip of the iceberg. You know, the process of searching for an investment, searching for a real estate deal, searching for the right thing. Like I look back on things like if I could have spent less time on that and more time on increasing income or increasing skills to increase income, I would have gotten better return for that time. So that's something that like
Sure.
I really talk about. I think it's important. Like the investing is the tip of the iceberg. That's the result of all the work you put in ahead of time to have the confidence to let that money go and just let it ride.
Yeah. Right on. All right. And where can the audience reach you?
The best way to get me is going to be on Instagram. So you can message me anytime. That's me personally. It's Strive for 25, I think _. Honestly, I forget what it is. But it's if you search Strive for 25, there's an underscore somewhere in there, but you'll find me.
We'll get all your links posted below, but thank you so much for your time. This is great.
Thanks, Sean. I appreciate it.
All right. We'll see you.
See ya.